Hello and welcome to BDO's July 2019 Financial Reporting and Accounting Standards webinar on disclosing information under AASB 15, revenue from contracts with customers. And I think probably some of you have already guessed, I'm not Aletta Boshoff. My name is Dean Arden and I'm an Associate Director in the IFRS Advisory Group in the Melbourne office of BDO. Unfortunately, Aletta can't be with us today to do the seminar. She's actually overseas, but in her place, I'll do my best. As I said, I'll be your tour guide for today's trip through disclosure requirements in AASB 15. So, without further ado, let's get into the webinar. To give some context to the disclosure requirements we're going to look at today, this article from the West Australian was published in May this year, paints a pretty compelling picture, I suppose, of the importance of getting the revenue number right. Now, the article is fairly light on in details, but it highlights the emphasis the market puts on revenue as an overall measure of performance. Now, since the article was published, CIMIC share price has dropped around to about $45 a share, and until more recently when it dropped to actually about $35 a share. Now, that's not to say that a recent fall in CIMIC's share price can be attributed directly to its battle with the market's perceptions of the entity's revenue numbers, but I think it really clearly indicates the impact of speculation around the revenue numbers and how that hasn't helped its financial position. Now, this slide hopefully also provides some context to today's discussion regarding the impact of the first-time adoption of IFRS 15 and IFRS 9. And the impacts that they can have on the balance sheet. Now, in comparison to AASB 9, IFRS 15 had a significant first-time impact on all of these listed ASX companies in the table, including the aforementioned CIMIC. Now, just running down the column, the percentage change in retained earnings arising from the first-time application of IFRS 15 is actually as follows. It's not in the table. I'll just read it out to you. So, Brambles Limited. Is around about a negative 12% drop in retained earnings. CIMIC Group Limited, approximately minus 28% drop in retained earnings. CSL Limited, approximately a 1.5% increase in retained earnings. Down at EDI Limited, negative 7.9% drop in retained earnings. Qantas Airways, an increase of 1.4% in retained earnings. Telstra Corporation, approximately an increase of 2.6%, and Vocus Group Limited, approximately a 1.5% decrease in retained earnings. So clearly the impact can range from immaterial to actually material. So obviously entities can only really understand the impact until they actually apply the standard. But it does give a certain impression that there could be significant impacts to your retained earnings figures and for your profit figures going forward by the initial application of AASB 15. Now, I've been given strict instructions by Aletta to make sure everyone's wide awake and alert, and more importantly prepared for the discussion on disclosure requirements to follow. So to this end, we've got some quiz questions. So if we start at the start, question 1, what are the standards impacting disclosure in respect of adoption of AASB 15? Now, I think I could give you a hint, but I think you'd probably already guessed that AASB 15 is probably one of those standards. I'll give you a moment to think about it. And the answer being, well, obviously AASB 15, but also AASB 101, so presentation of financial statements, and AASB 108 on accounting policies and errors and estimates. AASB 101 deals with items presented on the face of the financial statements, including revenue. So obviously it's going to be impacted by 15. And AASB 108, particularly in terms of transition requirements and transition disclosures, is also going to be relevant to the adoption of AASB 15. Question 2, if there are no impacts in respect to revenue timing, there'll be no impacts on your opening retained earnings, true or false? I'll give you a moment to have a think about it. And the answer is actually false. AASB not only deals with revenue recognition, it also deals with accounting for costs arising from contracts with customers. So if any entity has capitalised costs in the past that don't meet the criteria in AASB 15 for capitalisation of costs, they'll need to be derecognised as an adjustment to the opening retained profits. So obviously that's going to have an impact on the opening retained profits on first time application of AASB 15. Moving on, question 3. If there are no impacts in respect to retained earnings on adoption of AASB 15, there'll be no impact on the presentation of your income statement. True or false? I'll give you a moment to think about it. The answer is actually false. I won't go into detail here on the reasons why, because it's actually a topic of discussion later in this webinar, but suffice to say that under AASB 15, entities will be required to provide a greater level of disaggregation in relation to their revenue numbers, and some of which might be provided in their income statements. So notwithstanding that the standard might not affect the actual revenue numbers recognised, it might actually impact where they're presented and the detail in which they're presented. Question 4. If there can be no impacts in respect to retained earnings on adoption of AASB 15, can the adoption of AASB 15 impact the presentation of your balance sheet? Give you a moment to think about it. The answer is yes, can actually impact it. Again, we'll cover this area later in the webinar, but AASB 15 requires contract assets to be disclosed separately from costs capitalised that were incurred to obtain contracts with customers. So that's one impact that AASB 15 might have on your balance sheet. Previously, an entity might not have actually made a distinction between those two items. Under 15, there is a requirement to make that distinction, obviously, if they're material. Question 5. What are the potential impacts on your profit and loss presentation, assuming no impact on retained earnings on net profit? And I'm guessing here, because AASB 15 impacts both revenue and cost recognition and measurement standards, likely to impact more than one item. And yes, it does impact more than one item. So AASB 15 has the potential to reduce revenue, but it might also increase revenue, just depending on the facts and circumstances. It also has the capacity to reduce gross profit. So again, depending on the facts and circumstances. Payments to customers. It will impact how any payments to customers are accounted for. Generally, they're treated as a reduction in income, the revenue figure. And also the agent versus principal questions. Could impact the agent, that assessment. There's more guidance in AASB 15. As a consequence, some entities are looking at their agency and principal assessments in the past and reassessing those. And that does actually change the presentation of their financial presentation of the numbers in the profit and loss statement. Then we have question 6. How can the adoption of AASB 15 impact the balance sheet presentation, even if there are no impacts on the retained earnings or net profit? The answer is, well, in a multitude of ways. There might be no deferred revenue, there might be no accrued revenue. It will impact in respect to contract assets, contract liabilities. It also might impact in terms of reduced inventory. Now, it's not necessarily the fact that it's going to make inventory disappear. It's got to do with the fact that the timing of the recognition of the derecognition of the inventory on sale to a customer. It will also impact things like right of return assets and possibly netting agent arrangements. Question 7. Why does the following revenue recognition note not comply with AASB 15? I'll give you a brief moment to actually have a quick read through it, but I will draw your attention to some of the key criteria in it. So, for example, maybe in relation to maybe risks and rewards, whether or not that's relevant under AASB 15. So in terms of the types of areas where this disclosure is deficient, for example, revenue under AASB 15, revenue on goods recognised when control passes, so not when the significant risks or rewards of ownerships have changed. Other deficiencies, AASB 15 requires that if it's reasonable to assume the entity will accept discounted consideration for the customer's credit risk, the consideration is actually reduced. The consideration is that the purchase consideration is actually reduced for this fact. Previously, we might have looked at that and not just thought, well, that's just an issue of collectability. AASB 15 does actually provide additional guidance to what had existed previously to say, well, you need to think about what the consideration is. It might not necessarily be the actual amount that's written in the contract. There might be an implied or express expectation that the customer might pay less. In terms of revenue, the amount the entity is entitled to, again, if there's evidence to suggest that the entity will accept a lesser amount in consideration for the goods or services, not necessarily from credit risk, but for other reasons, that has to be adjusted into the amount of consideration or revenue. Other factors, there's no mention of the reversal constraint in this accounting policy. Now, I won't go into detail here again, but I know this is a matter that's been discussed by letter in other video webinars. Now, the reversal constraint is in the requirement in paragraph 56 of AASB 15 to only include in the transaction price consideration to the extent it's highly probable that a significant reversal in the amount of the cumulative revenue recognised will occur when the associated uncertainty is resolved. That wasn't a feature of the requirements under AASB 118 or IAS 18. Those standards were also required on that issue. Generally, you took the issue of, well, it's either probable or not. There wasn't any kind of middle ground in terms of determining whether or not it's likely that the revenue will be received. And there's not enough detail fundamentally, and this is what we're going to look at in today's webinar. Question 8. The adoption of the partial retrospective transition method requires the same disclosures as the full retrospective method. Now, true or false? Now, the partial retrospective method involves an entity actually recognising the cumulative effect of the initial application of the standard at the date of initial application. So that is, the entity is not required to actually restate the comparative financial statements in the period in which they first adopt AASB 15. And the answer to that is false. AASB 15, paragraph C8 in the Appendix C does make it absolutely clear that for reporting entities that include the date of initial application, an entity should provide both the following additional disclosures if the standard is applied retrospectively in accordance with C3B, which is the partial retrospective method. So have to disclose the amount by which each financial statement line item is affected in the current reporting period by the application of the standard, as compared to AASB 111, AASB 118, and the other related interpretations before the change, and an explanation of the reasons for the significant changes identified in C8A. Question 9. Application of the full retrospective transition model requires 3 balance sheets, so including one at the opening comparative period, so 1st July 2017, true or false? And the answer is false. Thankfully, the standard set is thought better than trying to expect people to provide an additional balance sheet like you would if you were correcting an accounting, past period accounting error, or a retrospective application of any other standard. They decided to relieve entities of that requirement of providing a 3rd balance sheet. Now, in terms of examples of entities that have already disclosed information regarding the impact of AASB 15, you might want to look at some of these entities. For example, the GWA Group Limited. Now, their most recent half-year financial statements actually confirmed that the impact of AASB 15 was limited to accounting for estimated future stock returns, which led to a decrease in sales revenue and cost of revenues, resulting in a non-effect on the gross profit, so nil change in gross profit. But it did impact the top-level numbers of sales and cost of sales. Other entities that you might want to look at to get some kind of perception of maybe what the kind of disclosures on impact might look like. Examples are Ramsey Health Limited and Webjet. Now, for instance, Ramsey Health, in its December 2018 interim financial statements, disclosed as a change in presentation of revenue for certain contracts between the group and the National Health Service in the UK, which resulted in an increase in the revenue and a corresponding increase in the health professional consultant fees as a result of Ramsey actually treating itself as the principal in the transaction with the NHS rather than actually the agent. So obviously, even just changes in assumptions like whether or not you're an agent or principal can actually have some significant impacts on your financial statements, particularly if you're in that kind of area where you might be, your relationships with other entities might be that you are either facilitating the provision of goods or services to a customer, or that you are requiring someone else to facilitate that provision on your behalf. Now, other entities that you might want to look at that might be relevant. Netting is another example, another area that AASB 15 impacts. In these cases, the impact was felt through netting amounts in the profit and loss. So, for example, in terms of Tabcorp's commissions, for example, it's December 2018 half-year financials. The company disclosed that certain commissions were going to be reclassified out of operating expenses and presented as a reduction in revenue. So netted off against revenue on the face of the income statement, but obviously that changes their top line number from a larger number to a smaller number as a consequence of that commission arrangement. So if we turn now and have a look at the specific disclosures required under AASB 15, and I won't go through all the disclosures in detail, but rather I might just pick out some of the more significant disclosures and maybe discuss these ones in a bit more detail. And the first set of disclosures we're looking at is these are sort of the generic ones. And I don't know if you follow the sort of the way that standard setters write the standards. You might have noticed in the last couple of years the ISB have been including disclosure objective paragraphs in new standards. Now these paragraphs serve a number of purposes, including giving preparers some structure and content to the individual disclosure requirements, but they also provide a framework, and I think that the framework is actually quite useful to help preparers interpret the individual requirements, the individual disclosure requirements that usually follow these generic sort of disclosure objective paragraphs, and it'll help them to apply the individual requirements in their particular circumstances. And also I think it also gives entities a better understanding of what kind of information to disclose and how much. So if we look at, for example, paragraph 110, 110, we can get a sense of what it's trying to identify there. So it states the objective of the disclosure requirements for an entity to disclose sufficient information to enable users of financial statements to understand the nature, amount, timing, and uncertainty of revenue and cash flows arising from contracts with customers. So for new standards, the ISB has also been including guidance regarding the level of detail that should be disclosed, which I think has always been a real challenge for a lot of entities, is to actually get the balance between enough information, enough useful information, but also quantity information in their financial statements. And I know dealing with clients and assisting them to try and interpret the standards, when faced with vague disclosure principles, I find that entities often over-disclose. And in these situations, I think the quality of disclosures actually suffer. I mean, their intentions are good, but putting too much information often into financial statements for the sake of that information and not to actually address something that's important, it can actually diminish the quality of the information actually provided. And that's why paragraphs 111 and 112 have been included. The ISB have tried to give some guidance. In terms of the actual thing that you should be thinking about if you're preparing a set of financial statements under AASB 15, I think paragraph 110 really does highlight, I think, the important parts, and those are effectively to thinking about what are the features of my revenue streams, or what are the factors that impact my revenue streams that could change the timing and amounts of revenue that I receive over the course of a contract with a customer. And it's those types of things that can change the numbers reported as a consequence of my assumptions, or as a consequence of what actually happens in practice. Those are the things that I think entities should be thinking about when they're thinking to apply these standards. If something in a particular disclosure requirement doesn't make sense, standard setters do anticipate users and preparers will go back to paragraphs 110 to 112, have a think about it, and try and think of something that fits both sets of disclosure requirements. If we press on, have a look at paragraph 113. Now, paragraph 113 requires the key AASB 15 information, and that is revenue from contracts with customers and impairment losses arising from contracts to be separately presented on the face of the statement of the comprehensive income. And I think this paragraph is actually pretty clear. I don't think there's much that can be misinterpreted in this. There might be issues about the level of disclosure, and again, I'd go back to paragraphs 110 to 112 and think about, well, do I need to break this information down on the face, or can I put it in the notes? But more importantly, this requirement's actually saying, no, you need to, if material, need to disclose separately on the face of the income statement the revenue recognised from contracts with customers, from other sources of income, and any impairment losses recognised in respect to, say, contract assets arising with the same contracts with customers. Paragraphs 114 and 115 are they're actually interesting disclosure requirements, and I think entities will need to think about these disclosures in a bit of detail before that they actually, commit to paper. If you're a listed entity, you presumably already had to think about these disclosure requirements because they're actually incorporated into AASB 134 interim financial reporting. So you would have had to apply them in your most recent interim financial statements. And this is actually a good outcome for everyone, I think, because what it means is that there's probably some examples out there that we can look at that we don't have to reinvent the wheel. We can actually find some good examples out there to comply with that we can use to base our own disclosures on. I think these disclosures are as close to the core principle in paragraph 110 of AASB 15 as you're likely to get. So if you think about paragraph 114 states that an entity shall disaggregate revenue recognised from contracts with customers into categories that depict how the nature, amount, timing and uncertainty of revenue and cash flows are affected by economic factors. And an entity shall apply the guidance in paragraphs B87 to B89 when selecting the categories to use to disaggregate revenue. What this disclosure requirement is actually saying is give the user some understanding of different groups of revenue based on the uncertainty of the timing and the amount of the cash flows. And AASB 15, paragraph 115 supports that when it states, so in addition, an entity shall disclose sufficient information to enable users of financial statements to understand the relationship to disclosure of disaggregated revenue in accordance with paragraphs 114, and revenue information is disclosed for each reportable segment if the entity applies the IFRS 8 operating segments. So what it's actually doing is sort of twofold. It's saying, one, you've got to break the revenue down into categories which that the contents have similar timing and amount risks. And when you do that, you need to then think about how do you then disclose that again. So how do you cut and dice that information again for the purpose of pure operating segment disclosures? Now, I think what these two disclosure paragraphs are really asking is for entities to think about those risks inherent in each of their identifiable revenue streams and to categorise and disclose the different revenue streams on the basis of these risks. Now, key risks are obviously timing and amount, as I mentioned before, but these risks might also be linked to other characteristics such as maybe nature and the geographical location of the customers. So you need to think about what are the keys driving my risks, what are my risks, what do I understand to be the risks associated with each of my significant revenue streams, and what's maybe the key drivers. And if I can categorise them based on the key drivers, I might be able to summarise that information a bit more effectively for the users and save myself a bit of time and effort in terms of as a preparer to try and communicate that information as well. Now, to assist entities in interpreting and applying paragraphs 114 and 115, the ISB have actually helpfully provided application guidance in the form of paragraphs B87 and B89. Now, for instance, paragraph B87 confirms that depending on the facts and circumstances, an entity might disaggregate its revenue numbers based on one, two, or more factors. Common factors I've seen to date that entities have used to disaggregate their revenue information include geographical location of the customer, I think, which can proxy probably for a couple of different risks, maybe including currency risk, but also maybe credit risk, but also maybe legislative or sort of statutory environment risk, and the type of customer, particularly government versus private sector. I think everyone seems to look at government slightly different to private sector, but again, I wouldn't be saying that that's a hard and fast rule. You step outside of, we think of government sector in terms of Australia, but if we start thinking of government sectors from other countries, we might have different views of the risks associated with them. Paragraph B89 provides a really useful list of potential bases for disaggregating revenue. It's really important though to remember that the basis of disaggregating the revenue has to be relevant to the entity. So, for example, it would make no sense if I was an entity and preparing disclosures on AASB 15 and I only sell goods and services to entities located in Australia. It would make no sense for me to try and disaggregate based on geographical region. I mean, it doesn't have any relevance to me as an entity, or even market or type of customer. For example, if I've only got one type of customer, and in those sort of cases, you might want to include, if it's unclear and that you want to make sure that people understand where your revenue is sourced from and how it's sourced, a short qualitative disclosure around the general nature of your customers. We sell predominantly to government entities. We sell predominantly to government entities in Australia. We sell predominantly to government entities within Australia, and we only sell them this type of good or service. And so you're really drawing a line under the risks and saying, look, it's got nothing to do with these things. They're all very, very similar. The critical bits are the following. And I think that's a good probably place to start. Interestingly, in paragraph B88, the ISB draw attention to the relevance of the disclosures entities make to the market about their revenues actually outside of their financial statements. And this might be particularly relevant to listed entities. So if you are disclosing your revenue streams in one particular way to the market, say through investors' updates and similar types of media, then you need to really think, well, if that's the way I'm communicating that to the users of this, of this product, that my media releases, why wouldn't I also be using that basis to communicate the different risks associated with my revenue to the users of my financial statements? I mean, they're probably one in the same group to a large extent, greater or lesser extent. But also importantly, it's creating a consistent message to the market, ensuring that the market understands why are you telling me one thing in one context and something else in another? Doesn't make sense. I'm confused. I don't know what's going on. To avoid all of that, to think about more broadly your disclosures in the context of your wider disclosures to the market. Paragraph B88 really does emphasise that fact that you need to consider those things in terms of, and in fact it may be quite useful to you as a preparer too, to be able to not have to reinvent the wheel. I'm just going to use that because it fits in nicely with the AASB 15 disclosure requirements. Now, if we turn our attention now to paragraphs 116 and 117. Paragraph 116 in AASB 15 separates out what may have previously been lumped into a single item by distinguishing between receivables, which is revenue recognisable to date, from contract assets, which includes maybe costs incurred to fulfil a contract with a customer, and contract liabilities, which is actually in effect cash received in respect to performance obligations that are yet to be fulfilled. And this paragraph actually then requires each of these items to be separately disclosed, either in the notes or on the face of the financial statements, which gives entities obviously a choice for a bit of flexibility, but the important thing is it's actually disclosed somewhere. Paragraph 117, really what's that there to do is to actually help users understand the relationship between these three items. So paragraph 117 requires entities to explain how the timing of a satisfaction of its performance obligations relates to the timing of the payments, and therefore the relationship between, say, the carrying amounts of receivables, contracts assets, and contract liabilities. So for those of you who listened to previous webinars that Aletta's done on AASB 15, there is potentially a mismatch between these things. It's very common in business for entities to invoice customers before performance obligations, for example, are met as a way of funding what they're doing for the customer. Now, if that's the case, the money coming in represents a contract liability because you've received the money before you've perhaps fulfilled any of your performance obligations, but you may have actually incurred some costs. So you might have actually incurred some costs like legal costs to sign the agreement with the customer, and you've capitalised those to your balance sheet. Now, as you start meeting your performance obligations, that's prepaid or that accrued revenue will start to unwind and appear in the profit and loss statement as revenue as you fulfil your performance obligations. If it's over time or at that point in time you do fulfil your performance obligations, if it's a point in time issue. And at that point in time, then you can say, oh, okay, now I can see the relationship. Money comes in first, I incur some costs around that time, but then the revenue starts to unwind, and then the contract costs start to get amortised over that time as well. Or maybe they're just deferred until such time as I hand the ultimate good or service to the customer. The point of it is to try and understand what's the interaction between these three items, so users can get a better understanding and be able to get a better handle on what's going to happen in the next 12 to 18 months around those particular customer contracts. So are we going to see more income hitting the P&L? Are we going to see more expenses hitting the P&L, or both? So turning now to paragraph 118, meeting its performance obligations is one cause of changes in carrying amounts of receivables, contract assets, and contract liabilities. But it's really important to remember that there are other causes of changes in the carrying amounts of these items. So to separate out the impact of the entities meeting their performance obligations from their day-to-day interactions with customers from other potential causes of these changes in balances of these items, paragraph 118 actually requires disaggregated disclosures. Now, for most entities, I would expect they'd probably address this disclosure requirement by providing maybe a quantitative reconciliation of the opening and closing balances of each item. But it's entirely up to an entity. I mean, these are principle-based disclosure requirements, and an entity might determine that there's other ways that they might want to do it, or that they can potentially do it. So paragraph 118 doesn't restrict. It simply says you should include qualitative and quantitative information, because obviously both of those things will be important in this context. We're talking about quantitative items that we measure, so therefore we would expect that you provide some quantitative information, but you might also need to provide some qualitative information, particularly around, say, for example, changes due to business combinations. So the timing of, when did these contract assets and contract liabilities that we acquired when we acquired a new business, when did they hit our balance sheet, and when did they start winding off in our balance sheet? So you need to think about how you convey to the user exactly what is happening and when it happened. But obviously an entity would only provide those reconciliations if they were material changes in the balances of the receivables, the contract assets and the contract liabilities, and that actually couldn't be explained by the entity achieving its performance obligations. So obviously, and sometimes I do see it, and I understand people are under time pressure and you just move on, but often you see maybe sometimes reconciliation tables where they'll have line items like changes as a consequence of business combination, and there's the actual line items are null, there's nothing in them, and you sort of go, well, it's an irrelevant piece of information. I'm just adding to the length of this, not significantly, but you are adding to the length of the set financial statements. So if it's something's not relevant, my view is always just to get rid of it. Moving on to paragraph 119. Now, for any of you that have had to apply AASB 15, particularly to a situation involving the sale of multiple goods and services, I think you can probably appreciate that identifying the distinct performance obligations is a pretty challenging task, typically because it often requires the exercise of some judgment. So unsurprisingly then, AASB 15 does require entities to disclose information about their performance obligations, including, as per AASB 119, when the entity typically satisfies its performance obligations, for example, upon shipment, upon delivery, the services are rendered, or upon completion of service, including when performance obligations are satisfied in the bill and hold arrangement. The significant payment terms, for example, when a payment is typically due, whether the contract has a significant financing component, whether the consideration amount is variable, whether the estimate of variable consideration is typically constrained in accordance with paragraphs 56 to 58, and so on. The nature of the goods and services, obligations for returns, refunds, types of warranties and related obligations. I mean, this is all really contextual information. And for many entities, I think it would be probably fairly straightforward. If they're selling one or two goods or one or two services, you generally find that the disclosures under AASB 119 will be very short and straightforward, particularly for listed companies that are known. So they know, people know what they do. So, for example, Coles, you would expect that they disclose, well, we retail, we're a supermarket, we retail supermarket-related goods and services. So, in terms of actually detailing the individual goods and services, you wouldn't see Coles do that, but you'd expect them to at least acknowledge this is what we do. And then obviously users would use that as a context to the other disclosures, the more important information about uncertainty of timing and amounts of contract revenue from customers. Moving on to paragraphs 120 to 122. Now, to understand the pattern of timing of revenue recognition in respect to uncompleted contracts with customers at the reporting date, paragraph 120 pretty clearly states that an entity shall disclose the following information about remaining performance obligations. So the aggregate amount of the transaction price allocated to the performance obligations that are unsatisfied or partially unsatisfied as of the end of the reporting period, and an explanation of when the entity expects to recognise as revenue the amount disclosed in accordance with paragraph 120A, which the entity shall disclose in either of the following ways: on a quantitative basis, using the time bands that would be most appropriate for the duration of the remaining performance obligations, or maybe by using qualitative information if they thought that was a better way of trying to communicate that particular piece of information. These requirements need to think about things like a transaction price. We're not talking here about unearned revenue, we're talking about transaction price. So we're talking about what is likely to unroll, or what's likely to roll out through my P&L in the next 12 to 18 months if the contract with the customer finishes within that period of time. What as a user, what do I expect to see to roll out through P&L in respect to that? And keeping in mind that for sometimes under AASB 15, not all of the transaction price may be recognised in respect to, or that we account for in respect to a particular contract with the customer until such time as maybe the uncertainty around it is resolved. So, for example, you might say, well, to date, I've only recognised $100,000 in respect to this customer contract, but there's maybe a performance bonus at the end, which I'm not sure I'm going to get, and that is of a quantum of maybe $2 million. And all of a sudden, when a user's given that kind of information, it does change obviously their expectations about what the numbers are going to be going forward, and it does impact their understanding of those financial statements. So, make the distinction between transaction price and accrued revenue. The two things might not be the same due to various of the requirements under AASB 15. Now, paragraphs 121 and 122 confirm the circumstances in which an entity wouldn't need to make disclosures under paragraph 120, and the types of disclosures the entities would make to put users on notice of for which they have some uncompleted contracts with customers. They haven't disclosed any quantitative information about the related transaction price. AASB 15 requires or provides a whole number of practical expedients that entities can apply. If they're applying that, then obviously there needs to be some indication in the financial statements of the entity that is their accounting policy, and therefore users need to be aware, I'm not going to see numbers in relation to perhaps this thing because the entity's applied a practical expedient. For instance, paragraph B16 deals with situations where an entity bills a customer a fixed amount for each hour of work. In this case, an entity doesn't need to disclose the quantitative information about the unsatisfied performance obligations. So if you think about it, maybe you're an entity that provides cleaning services, but you do it on an hourly basis, on an as-need basis, but you're actually working under a contract with a customer that's going to go for 3 years. And you sort of know, well, I know, over those 3 years, notwithstanding it's an on-needs basis, I reckon I'm going to be, recognising, $100,000 worth of revenue over the 3 years in respect to that contract. But if that's the case, if you're only charging on an hour-by-hour basis, the standard doesn't require you to then think about, well, okay, I've charged $20,000 to date in respect to this contract, therefore I've got another $80,000 of that contract to be fulfilled, because it's only an estimate. I'm doing it on an hourly basis. So the standard doesn't say, well, you wouldn't disclose that, because that would imply perhaps you're going to get more revenue from this contract than you may actually get. It's a horses for courses type approach, and they're also saying if you're using practical expedients, disclose those practical expedients, but don't go to the point of actually making information appear different than what the actual practical circumstances are. Now, with respect to paragraphs 123 to 126, so consistent with my previous comments about the judgment sometimes necessary in identifying distinct performance obligations, paragraphs 123 to 126 require disclosures about some judgments, as well as any other significant judgments required to apply AASB 15. So, for instance, paragraphs 124 requires for performance obligations that an entity satisfies over time, an entity should disclose both the following: the methods used to recognise revenue, for example, a description of the output methods or input methods used, and how those methods are applied, and an explanation of why the methods used to provide actually do provide a faithful depiction of the transfer of goods or services. Now, similarly, paragraph 125 requires for performance obligations satisfied at a point in time, an entity shall disclose the significant judgments made in evaluating when a customer obtains control of promised goods or services. Now, both of these disclosure requirements anticipate, for instance, an entity might apply, and I'm just thinking more generally here, you might apply a single revenue recognition method, so like an output method, to actually a group of obligations that are only collectively distinct performance obligations under AASB 15. Or you might apply a particular output method that is a proxy for the transfer of control, such as, say, the due date for physical delivery rather than the actual physical delivery of the product. Now, this information is useful to assessing the reliability and potential variability of revenue under the current portfolio of an entity's customer contracts going forward. And that's why AASB 15 requires its disclosure. It's acknowledging that in applying 15, we might have to make some judgments, and if we use those judgments, we need to disclose what those judgments are so people have an understanding of the basis on which those numbers are prepared. There is an example, and I'll come to it in a minute, talking about Woodside, which gives a sort of a better sort of description, or it sort of explains why these disclosure requirements are important and what the benefits of them are. Now, if you look at the disclosures under the first dot point in the left-hand column here of Woodside's, and we're just taking this straight from Woodside's financial statements, Woodside assumes the control of produced hydrocarbons transfers, or at least it assumes that the control passes for the purpose of AASB 15 on delivery, whereas revenue from, say, take-or-pay contracts is recognised when the product's been drawn down by the client or by the customer. Now, with regards to the key estimates and judgments, Woodside confirms that it assumes transfer of control of hydrocarbons occurs when legal titles transferred and/or significant risks and rewards are transferred, and/or maybe the present right to payments established. Now, you might ask yourself, well, why is there uncertainty? But if you think about the product, it's likely being transported, the product that is that Woodside's talking about, the hydrocarbons, it's likely being transported by a pipe. So delivery, it's not a case where a delivery driver turns up with a box of hydrocarbons on the customer's doorstep and physically hands them to them. Woodside is pushing the hydrocarbons through a pipe, and the customer probably gets used to them somewhere down the line in the pipe, through access to the pipe. Now, Woodside themselves don't physically watch the customer using the hydrocarbons, but they would be able to measure the amount of hydrocarbons that is being drawn out of the pipe, and therefore would be able to actually determine, yes, well, that's the nature of our contractual arrangement. The hydrocarbons is coming out at that point where the customer's at, and so therefore we assume that we're now entitled to payment for the goods under the contract. So in some circumstances, in a straightforward retail case, you can always see physically where the transaction occurred, whereas in other cases it might not be as clear. So sometimes you do have to use judgments. And again, I wouldn't expect that these would be common, thinking about relative terms, across all the different types of entities, but I'm sure that there are lots of similar sort of scenarios where entities might have to look at it and say, well, I don't have tangible physical evidence of the moment that the customer took control of the goods or services, but I've got quite strong evidence to suggest that the timing was at or around this point in time. And as a proxy for that, I use, for example, the point in time when I notice the hydrocarbons leave the pipe that I'm in charge of and enter the customer's pipe. If that's the case, I'm entitled to payment, so therefore I recognise the revenue at that point in time. Now, in terms of some other disclosure requirements, for the same reasons AASB 15 requires disclosure of information around the measurement of revenue and deferred revenue, it actually also requires disclosure of assumptions used to measure contract costs, as well as amortising and impairing contract costs. Now, AASB 15 requires where material a breakdown of the contract costs by category of assets, such as contract acquisition costs and setup costs. I think the purpose of this is really to give users some understanding about what's the costs associated with getting a contract, and therefore really what's the profitability of that contract. To help people understand, users that is, to understand the nature of those items, paragraph 128 also requires an entity to disclose all the following: the closing balances of assets recognised, and the amortisation and impairment losses recognised for the reporting period. So again, it gives an indication of how successful has this entity been in identifying profitable contracts with customers and executing those profitable contracts with customers. Again, consistent with my previous comments on disclosures regarding transaction prices, AASB 15 paragraph 129 requires entities to disclose whether they're using the practical expedients in relation to the significant financing components and or expensing incremental costs of obtaining a contract. Again, these practical expedients exist. The purpose of them is to make the application of AASB 15 easier, and so as a consequence, entities, think about the the practical expedient of expensing incremental costs in respect to contracts that end within 12 months. There's nothing to recognise except an expense, and I suppose that gives context to that expense amount. So, for example, if a user was looking at a set of financial statements that an entity has applied the practical expedient for in respect to the incremental cost of obtaining a contract, they could then, adjust their perceptions of this arrangement. Say, oh, okay, well, I can see that they're actually expensing these costs. They're not capitalising those, so therefore I'm not expecting to see a smooth recognition of incremental costs. I would expect to see if the entity really starts to write more customer contracts, then I'd expect to see the expenses to go up as well. And that explains why those expenses are going up when I do see them. I won't go into detail on these. AASB 108, these disclosure requirements have been around for a long time, and so they're pretty standard. That they're the ones that apply whenever an entity applies a new standard, and they apply in the year in which they apply the new standard. They're stock standard. The title of the accounting standard disclosed when applicable, the change is made in accordance with the transitional provisions, the actual change in the accounting policy, description of transitional provisions, impacts line by line, and so on. For anyone who's actually done a first-time application of standard before, they'd be pretty familiar with those disclosure requirements. They're pretty stock standard. That takes us to the point where we say, if anything I've discussed today actually made you think I need to read up on the application of AASB 15, BDO is actually a number of materials that are available to you. I know the letters been recording webinars furiously for the last couple of years, so access to those, you can get access to those through those links there on this slide. We also have publications available, again, accessible through those links, which will give you some understanding about the application and interpretation of AASB 15. We've also got e-learning modules, which are available online through the BDO Australia website. Covered a range of areas, including disclosures that we've discussed today, and how to apply AASB 15 to various different types of industries and entities. If you need assistance, and I'm sure there's some entities out there that do, particularly not just about disclosure requirements, but any other aspect of the application of AASB 15, I'd suggest you contact the BDO technical leader nearest to you. We have obviously a letter Boshoff in Melbourne. We've also got Kevin Frobus in Sydney, Clark Gerald in Brisbane, and Wayne Basford and Susan Oldmeadow Hall in Perth. And that is a complete list of all of the other staff, all of the staff in the IFRS Advisory Group and BDO. And on that note, I think that's the end of today's webinar. I hope you got some useful takeaways. And until I speak to you again, happy reporting.